reason is that the total the household financial savings, the household sector's financial savings, the savings that go to the financial markets or the bank deposits or post office and all, are around 7.98% of the GDP. If the central government borrows around 3.5% of GDP, the state governments also borrow money, and that's another 3% of GDP. That leaves very little bit of the savings for the private sector investment for the rest of the economy. And that's why if the government is borrowing more money, it will impact the investment capability of the private sector. They will crowd out the private investment. The other thing is that the total amount of debt the government of India has issued over the years, every year government borrows few lakh crore rupees, and then the total debt keeps increasing. State governments are also borrowing money, and put together the total amount is like 68-69% of our total GDP. So much so that this year the government of India will be paying more than 5 lakh crores only as the interest amount on the amount that the government has borrowed over the years, which is a huge amount. In fact, the total fiscal deficit and the interest expenditure is same. If the government keeps on borrowing more money, that amount can become quite large and it will be unsustainable. The third thing is that if the government consumes more, if the government is spending more money, and we have seen that in 2009, 10, 11 or whatever, the 10, 11, 12, when the government was spending more money, the subsidy bill was going up, and also the RBI cut interest rates, they did not tighten too much. It resulted in inflation, it resulted in higher current account deficit, it resulted in higher interest rates. And you remember in 2013, the rupee fell from like almost less than 50 to 68, 69 rupees in a few months time, and we were considered as one of those fragile 5 countries in the world. Remember that October 2013, and even during the slowdown, RBI had to increase interest rates because the CPI inflation went to almost 9%, and there was pressure on the currency, and we were worried about the macroeconomic stability. And that's why one of the most important thing, and I'll come to it, why it's so critical for a stock market also, one of the most important thing for a sustained bull market in equity is a stable macroeconomic environment. And the stable macroeconomic environment comes from having a fiscal prudence, having fiscally a very, very solid state, also a very responsible monetary policy. One of the biggest reform that has happened in last 2 years is on the monetary side, where now there is a monetary policy committee which has been given a target. It is signed between Reserve Bank of India and the Government of India, that Reserve Bank of India has to ensure that consumer price inflation CPI stays at around 4%. It could be slightly higher, slightly lower depending on the business cycle, economic cycle, but the RBI will ensure that consumer prices are at around 4%. If they are substantially higher, they will increase interest rates or use any other tool to ensure that inflation comes down. When you have that kind of a monetary policy, when you have a very fiscally responsible central government, these things together with a lot of other things that are happening in the economy will go a long way in ensuring that our macroeconomic environment remains stable. Otherwise, we have huge volatility. In 2013, you remember just because US, the Federal Reserve talked about the tapering of the quantitative easing, and our markets got impacted so much because the underlying macro environment wasn't that strong. I think for a sustained long-term bull market, one of the important thing is this macroeconomic stability. And I think the government is doing the right things in last couple of years to ensure that over a longer period, our macroeconomic environment is strong. Our foreign exchange reserves have gone up. Our current account deficit has come down. In fact, the foreign direct investment this year would be more than the current account deficit. The difference between the imports and exports, the total foreign direct investment is coming, is more than that. And a lot of other things that have been done in last couple of years, particularly to ensure that over a period of time, the black economy, the parallel economy shifts to the mainstream economy. So right, the demonetization was the last step, but even before that, whether it's a direct benefit transfer, whether it's the payment banks, so many payment banks are there. The whole jam trinity, the Jan Dhan Yojana, Aadhaar and mobility, moving towards over a period of time more and more digital finance, the GST, more usage of IT and analytics in the IT department. All of these will over a period of time, and the black money law, the what they have done in the real estate sector or for the gold sector and so on and so forth. In this budget, you had this measure of not more than 3 lakh rupees in the cash transaction, or even some of the measures to ensure that even the political funding becomes more and more clean. All these will ensure that over a longer period, the large part of the parallel economy shifts to the mainstream economy. When that happens, the tax to GDP ratio will go up. The government's tax revenues can go up very substantially. A lot of businesses that don't pay the excise duty or the sales tax or the VAT, and when they don't pay and don't show that sales, they don't show the profits also. So then the income tax also they are not paying, and so the government tax revenues are much smaller than what they should logically be. With all these measures, the government's tax revenues can go up. When that happens, government will have more money to invest in physical infrastructure, which is your roads and railways and power and ports and airports, so on and so forth, and the social infrastructure, which is your education, healthcare, and the other social infrastructure. Again, that is very critical to have a solid macro and a solid society on which economic growth can really flourish. And the third thing that will happen from all these things that have been done in terms of ensuring the parallel economy comes to the mainstream and the finance becomes digital, as I mentioned that after the 8th November demonetization, and even before that, the government has been trying hard to promote the digital finance. What it will do, it will ensure that a large part of the savings will become financialized. When people have deposited cash in the bank, and now that the money is disclosed, people will invest a lot more in the financial markets. Historically, a bulk of our savings have gone into gold and real estate. Going forward, we'll see, and that trend is already on for last 2 years, that increasingly more and more household savings will come into the equity market, which is very good for that a large part of the population will be able to take advantage of the growth potential in India. But this will do another good to us, and that is today, for last like 10 or 15 years, because the foreign institutional investors are the largest category of the investors in India. So they own, foreign institutions own almost 20 to 23% of the total market capitalization. So what happens at any time something happens in US, something happens in Greece, something happens in China, something happens to dollar, something happens to the European interest rates or Japanese interest rates, anything to do with the global liquidity, global risk appetite, global risk, global interest rates and all, when foreign investors are selling, our markets are going down. When they are buying, our markets are going up, because the domestic savings are very small. Now it's changing quite a bit because the domestic investors have started investing. So what it will do is that once the domestic investment increases in our market, structurally the vulnerability that we have on global events, that will substantially go down. Let's say something is happening in Greece, it will still impact everybody. We live in a hyper-connected world, but it won't impact the way it has historically been. So let's say in 2008, after the Lehman crisis, in that year, Indian markets fell more than 60% in one single year because something happened in US. Of course, we also had a bit of slowdown and other factors, but still the markets wouldn't have fallen if we were so dependent on the global flows, global money. So everything that has been done in last 2 years, and I can just go on, whether it was the bankruptcy code last year, it was the GST or the monetary policy committee or the Aadhaar bill, which can go a long way in improving the governance of India. For example, the direct benefit transfer, where large part of the subsidies, which everybody knows that a lot of leakages happen in the government spending or the subsidies, once more and more payments happen through the digital means or through the Aadhaar enabled cards, those leakages will stop over a period of time. So all these things that have been done will make India a very, very stable, will provide India a very stable macro environment here on which the economy can grow and the entrepreneurship can flourish. Because for a structural bull market, you need 4 things. And there is, I'm told there is another workshop on algo trading and the technical analysis or whatever. And I assume that everybody sitting here is not interested in how to make money tomorrow, but how to create wealth over a longer period of time. So I won't talk about where the market will be in next 1 month or 3 months, but more structurally, are we in a bull market or in a bear market? So for a structural long-term bull market, to me, you need 3 or 4 things together. The first is the a stable macroeconomic environment, which I just talked about. I think in India is moving towards that. A stable political environment for sure. I think the democracy has only been strengthening over the years, and despite being one of the most poorest country in the world, I think one thing we should all take pride in is the way democracy is strengthening, the way institutions are strengthening in India. And just one or two things before I move to the other three things which are critical for the stable, for the long-term structural bull market from this budget. As I mentioned, there's a lot of analysis has already happened of the budget, and I won't spend any more time on that. But one or two things I think which sometimes get missed. You know, the whole world after the victory of Donald Trump in US or the Brexit or the similar voices are gaining strength in the other parts of Europe, are becoming very anti-globalization, very anti-immigration, very anti-trade, very protectionist. And you see what's happening in India? The government dismantled FIPB, Foreign Investment Promotion Board. The government is talking about relaxing the FDI norms more. The government is talking about ease of doing business. So we are actually inviting more foreign competition here. So the world is moving in one direction, we are moving in another direction, which to me is more positive. The another interesting thing, and every year I keep saying that the focus of the budget should be more on the outcome, less on the outlays. Outlays meaning that, okay, if you say that instead of 10,000 crores, we have focus on healthcare, we'll spend 12,000 crores, it's 20% higher or 30% higher. But how do you know whether it's improving the overall health of our citizens? So there has to be more specific outcome which you want from every rupee that the government is spending. Some beginning has been made. I saw some measures like that, some comments in the speech like that. So when he talked about an NREGA payment, that whatever 38,000 crores, so this much amount of money, he also mentioned 5 lakh bonds, which is important. This much money, what is the result? We'll have 5 lakh bonds or some asset which is getting created, and then you have that satellite based some kind of monitoring or something where that asset is getting created. So that's an outcome based spending. Similarly, I think if I heard right, there was talk about some learning based outcome in the University Grant Commission when you are giving money to the colleges. I also heard about healthcare spending, that one disease, I think it was TB, that India will be we will eradicate TB by 2025 and one more disease by 2020, and there were like few others. This is a small beginning, but I think this is very, very critical. So I can just go on the measures that are happening overall. I think will structurally put India on a very, very stronger footing over a longer period of time. The other thing which is happening in India is very interesting is the way we are using the digital technology. We are, if I can use the word, we are leapfrogging, in a sense that I'm not sure how many private sector are investing that much in analytics and big data and things like that. When the finance minister talked about these many people have income above 5 lakhs, out of that many are in salaried class, whether it was the discussion about the soil card or the ponds under the NREGA, some kind of satellite based imaging technology and all. Then and I talked about the Aadhaar card and what all it can do after the demonetization, the number of people who deposited more than 80 lakhs or more than 30 lakhs and all. The amount of analytics, data and all which is available both to the government and to the private sector. So we are becoming a very data rich society. In fact, there is no other country where more than 1 billion people have got biometric card and identity, and it'll help so much going forward in improving the governance and improving the administration and opening up several opportunities for both the government as well as for the private entrepreneurs. So much so on the overall stable macroeconomic environment. That's critical for a structural long-term bull market. The second thing you need for a bull market is rising corporate profitability. The corporate profits have to grow, because at the end of the day, stock price is nothing but the slave of the company's earnings power. In last 20-25 years, corporate profits in India have grown at a pace of around 14-15% on an average. But last 5 years, it has been in single digit. In last 2 years particularly, every quarter you would be hearing from fund managers like me that now it is bottoming out. Now I think another quarter or two, the corporate profits will improve. But we have seen every quarter there is some or the other reason which is dragging down the corporate profits. For example, you had challenges on the NPA side, and which became bigger and bigger in last 2 years. Of course, now things are becoming better. So like financials are 30% of the overall market, and if there are NPA issues in some part of the banking sector, they drag the corporate profitability. When commodity prices fall, it is good for us as a nation that petrol and diesel prices are cheaper, or government is making more money in excise, or the input cost is going down, or inflation is going down. But a lot of companies where the earnings are based on the commodity prices, for example, let's say the metals companies or companies which are in the materials or metals or similar, there of course the profitability was lower. So many of the metal companies had large losses in last few quarters rather than the profits. There was challenge for 2 years. The rural economy was in distress. You had a poor monsoon. There were challenges for some sectors like pharmaceuticals, one after another. Then there were some certain issues. The IT sector, which has seen some amount of slowdown. Overall, global trade has slowed down in last couple of years. So companies which were more dependent on the exports, they had their own set of challenges. Some or the other reason, last 2 years, the corporate profits have been growing at a much lower rate than the historical long-term average. But my sense is that things are bottoming out, and with the right measures that have been taken by the government, the reforms that have happened, and I'll talk a little later about what are the other big growth drivers that can provide growth to the India's economy, and why the corporate profitability can improve from here on. But structurally in next 5 years, even if we go back to the long-term average of let's say 13-14% growth, then markets can deliver decent return over a longer period. The third thing you need for bull market is the starting valuations have to be reasonable. Valuations have to be cheap. Definitely markets are not cheap. So depending on, of course, after the demonetization, there were certain sectors which had where the numbers have to really undergo a revision, and we have been waiting for the entire earnings season to unfold, and maybe another few weeks the analysts will rework their entire numbers, and maybe I think depending on what the earning number for next year. But in general, I think markets are trading at around 16-17 times next year's earning for 2018 earning. Is this cheap? Not really. But if you remember in the past, like big bull market in 2008, we were trading at some 23-24 times. So we are definitely not very richly valued. We are in line with the long-term average, slightly higher maybe, but they are justified because interest rates are coming down, and also you have a visibility of, or probably a decent possibility of, a 3-5 year structural earnings growth. So we are trading at 16-17 times. So markets are not very richly valued. If the P ratio remains here, so let's say after 3 or 5 years our P remains at 16-17, during this period if earnings grow at like 13-14% every year, so logically what does it mean? Markets should deliver 13-14% return over the next 3-5 years. Last but not the least, the fourth factor you need for a structural that bull market is liquidity flow. So you can say that, let's say we are in Worli now, and then there is a flat, and I don't know which is the best building next door, and then it's a great flat, great society, great everything, best builder and all, but somebody has to put money on the table, then only the value is realized. Otherwise, I mean, that's it will remain good, but liquidity flow is very, very important. There are two sources of liquidity flow. You have foreign investors and you have domestic investors. I told you that foreign investors historically have always liked Indian markets. Even last 3 or 4 months where they had to sell Indian equities, not because they are bearish on India, but because the overall emerging markets in general are seeing some redemptions. The US markets are doing well. The dollar was strengthening, US dollar, and a lot of money has shifted from emerging markets like India to the developed markets like US and UK and Europe. So India also got impacted. If an emerging market fund manager had $100 million of fund, and he has invested $10 or $15 million in India, if he is getting a redemption of $10 million, he is selling $1 million of his Indian equities also. But structurally, all the fund managers that we speak to, or the other people that you might be hearing, in general, everybody thinks that structurally India is a good story. India is a structural long-term growth story, and at some point in time when more money comes into the emerging markets, or even otherwise if the global growth environment remains decent, money should come from foreign investors. In fact, between 2008, the slowdown that we had, and 2014, for 5 years, 2009 to 14, when investors like us, the domestic investors, were selling equities, foreign investors in those 6 years or so, if I remember the number correctly, invested almost $80–90 billion. When we were thinking there is a policy paralysis, there is an NPA problem, there is an excess debt problem, the growth is slowing down, domestic investors lost the faith in our equities, the global investors continued their faith in the Indian equities market, and I don't see any reason structurally longer term why they would not continue to invest money in India. But short term, of course, that depends on a lot of other global reasons. The bigger story for India from a liquidity perspective is the domestic investors. I am sure everybody knows about it. There are more than 1 crore SIP, live SIPs are there, on an average 4,000 crores of money that comes every month in the equity market. Then you have the provident funds who are investing maybe more than 15,000 crores. You have the NPS, you have the insurance, and all put together. In next few years, this pool of money can really provide a big support to the market. And the volatility that we used to have because of the foreigners inflow or outflow, I think can go down substantially. So I think this money can only increase substantially, because even today, all the domestic investors are substantially underweight on equities. People don't have the equity exposure. You will be surprised to know this, the equity savings today, the amount of money that investors in India used to invest in equities in late 80s and early 90s as a proportion of the financial savings was larger than where it is today. And you will remember, I think throughout 90s there used to be like one IPO almost every week, more than one IPO every week, and people had, we had such a great cult of equity, but somehow I think in last couple of years that has reduced, but it started improving. And now with the increased awareness about the mutual fund, the number of financial planners who are working hard, everybody is becoming aware that it's not the physical assets that we need to invest, but it's the financial assets. Equities and bonds are better investments, so that money can increase, and I think that will be one of the very important pillar of this sustainable market. So I think that with a stable macro environment, with rising corporate profitability, with the starting valuations which are reasonable and the liquidity flow, we could be in a structural bull market for next several years. Having said that, in the short run, even let's say when 2003 when Sensex was 3,000, and let's say the 2010 when Sensex would have been around 20,000, 3,000 and 20,000. So market went up 7 times in those 7 years, but you also had several years where market corrected very sharply. You had like 2008 where market corrected 60% in one single year, but then it bounced back equally sharply the next year. So you will always have some of those moves, and maybe if there are questions we can discuss about maybe what can happen in next few quarters, but I think more important thing is to get this picture right, that over a longer period we are in a very, very sweet spot, and things are looking really very attractive. Last 2 years particularly have not been very good from an index perspective. The investors in mutual funds have not realized that markets have almost been flat for 2 years, because if you had a mix of large cap, mid cap, multi cap fund, your returns would still be like reasonably good, more than the fixed deposit, and you didn't realize that actually the Nifty or the Sensex are almost flat for 2 years. But if you go back and in history, in last 35 years or so of the Sensex history, there have only been 3 instances where the market did not deliver good return in a third year. So first, if I remember correctly, was 86, 87, the Rajiv Gandhi second and third year. 85 was a big market rally. 86 and 87, 2 years where market did not deliver good returns. 1 year it was flat, and I think 1 year it was down in double digit. The second time, if I remember correctly, was I think 95, 96 or so, or 96, 97, where for 2 consecutive years you didn't make money. The third year was good. In 1 year it was flat, say 1% down or something. Second year it was I think down in double digit. The only time where the third year market did not deliver good return was 2000, 2001 and 2002. For 2 consecutive years you had like double digit negative return, and third year also market did not deliver. But remember, after that, from 2003 to 2008, Sensex went up from 3,000 to 21,000. So if you had a bad 2 or 3 year period, it has generally been followed by extraordinarily good period in the subsequent years. I don't want to increase expectations that there is going to be a similar kind of rally, but as I mentioned earlier, that if you if the corporate profits grow at the pace of, let's say, the nominal GDP growth, and the market delivers the same return, even then I think this is a very, very decent return. And we also have to keep in mind that what are the other investment avenues. Look at the deposit rates of 6 and 7%, and that's taxable. Here I think after 1 year you have the benefit of long-term capital gain tax, and thanks to finance minister it didn't make any change there, and then you get if you get double-digit returns. And I think the expectations itself from the equity market over a period I think will I think moderate, and that will encourage more flows into the equity market. Before I close for question and answer, one or two other things. There are some challenges in the economy. The private investments are not happening. Large part of the corporate sector has got a lot of debt. Banks still have some NPAs to deal with, and the lending capacity or the risk appetite is limited, particularly on the corporate side. There's a lot of capacity, overcapacity in several industries. And looking at the global environment, the corporate sector is, I would say, is not in a mood for a massive capex from the private sector side. The investment rate of India as a percentage of the GDP, the gross capital formation is at 26.6%, which is the lowest in last 10 years. So that's one of the challenge. But on the other side, the government's investments are increasing. So what are those 2 or 3 things or drivers that can drive the economy in next few years? And I'll only mention about 2 or 3 because some of these actually get missed out when we focus too much on the regular media news and maybe some of the things that are happening around us, what's happening in our economy. One of the interesting things that's happening in our economy is I think on the rural side. I think with the crop insurance, the agriculture insurance is one of the very, very big initiative that the government has taken, and that will ensure that over a period of time, the overall spending capability of the farmers or I think the confidence that they will have, and I think the vulnerability that they have in terms of the monsoon every year, that will go down. Not that the crop won't get impacted, but just the confidence that I get my money back, and you have these cycles where you hear about the suicides from the farmers and all that. I think that can change quite a bit. So crop insurance, then the road connectivity, which is increasing in India, even in the rural areas, the electricity availability, which is improving at a very, very fast pace. Our overall electricity generation capacity in last several years have gone up substantially, and government spending more money on the distribution of that, with transmission and distribution of that. So you have more road connectivity, you have more electricity, more money going into the irrigation, crop insurance, digital connectivity, with everybody getting more and more connected to the digital. So India, as I mentioned in the beginning, India is leapfrogging. You have more financial connectivity because everybody has got a bank account. So for government to do a direct benefit transfer, you would have heard this debate about the universal basic income for last few years. Maybe in few years time something like that may happen. Even otherwise, a lot of money that gets spent by the government will actually reach in his bank account, his or her bank account. The digital connectivity, the financial connectivity, the road connectivity, the electricity which is there, the crop insurance, all these things, more money in irrigation, the way agriculture productivity improves, the rural economy can actually be a very big growth driver for next few years. They of course had their own set of challenges in last 2 years because of the 2 poor monsoon, 4 bad crops, or the global agri commodity prices hit multi-year low, whether it's sugar, whether it's cotton, whether it's guar gum which gets exported from India, or the soya producers, cotton producers. I mean, so many of these agri commodity, the agricultural exports had come down significantly. But I think over the next couple of years, the rural India could be a big growth driver, and a lot of companies and businesses which cater to that demand can actually do very well. The other could be the affordable housing. Of course, in this budget, people would have heard about it on 31st December when PM also talked about some of the incentives for the interest subvention and all for affordable housing. But think about it, so much of idle investment is there in the land of so many investors in India. What are they going to do with it? I think with the tax incentives, and 30 and 60 meter is a very decent size for large part of the population in India, which comes under affordable housing. The income is tax free for anybody who's constructing that, and the availability of credit is becoming easier. There is so much of demand for the houses because large part of the population still doesn't have their don't have their own house. So I think affordable housing could actually be a big growth driver. And it's not only about the people who are constructing it, but everybody benefits. When you construct, let's say, a crore house in next few years, you will use more paint, you will use cement, you will use steel, you will use glass, you will use rubber, you will use tiles, you will use sanitary ware, you will use so many things, plywood and everything. So I think it will help a lot of companies. The another thing that's happening very interesting in our economy today is the access to credit, the availability of credit. And that's why a lot of people, when they ask me about how much RBI will cut the interest rate in next policy or next year, and I always mention it's not about a 50 basis point or 1%. The real India story in next few years is the person who's borrowing money at 60% or is not able to borrow money even at any rate will get money at 30% or 25%. The person borrowing at 30% will get at 18. The people borrowing at 18 will get at 12. The people borrowing at 12 will get at 8. And why is that happening? Look at the banks. Most of the private sector banks, the retail credit is growing at more than 20%. Even the slowdown in last few years in the overall corporate lending or the overall bank lending, the retail lending is growing at a very, very fast pace. For variety of reasons, we have the CIBIL score of people. The retail NPAs have been very low during this slowdown last few years. People are a lot more, I would say, the overall behavior has changed quite a bit. Banks have a lot more analytics and all at their disposal. You have the NBFCs growing so much. You have a lot of these housing finance companies growing very fast. Mortgage availability has improved so much for all kinds of borrowers. Then you have the small finance banks, the likes of Bandhan and Equitas and AU Financials and so many. Then you have the MFIs, they are like almost doubling every year or 2 year, and they are expanding very fast. The public sector banks, the retail credit is growing at a fast pace. I talked about the private sector banks, and it's becoming very easier for large number of borrowers. And now government has also got a lot of focus with all the Mudra and the other schemes to promote the entrepreneurship, because everybody knows that the job creation by the larger companies is very limited, the potential, so you need to create more entrepreneurship. I think this could be a big driver, and which is highly underappreciated in India, that the availability of credit is improving at a very fast pace, and it will, in next few years, as finance becomes more and more digital. So let's say somebody is running a small restaurant or a small tire shop or a small some kind of garage or anything. Today, because his entire transaction is cash, no bank or no NBFC lends him money. Now you start using the POS machine. All your money is coming through the credit cards or through the bank channel. The bank is a lot more comfortable with you. Large number of people are going to file tax returns now. So small businesses and all, the lot of lending which is happening in their formal channel will start moving towards the formal channel, and that could be a very, very big growth driver. And fourth, maybe I think the government spending, which I mentioned about the infrastructure. Of course, there are limited resources, and government had a tight rope to walk between fiscal deficit and more spending. They didn't want to increase that, so there was a limited amount of resources. But over a period of time, as tax to GDP improves, as more and more people pay taxes, that's why in fact this year the government is expecting the income tax, personal income tax collections to grow by 24.9, almost 25% this year, because they think that large number of people will come into the tax net. But over a period of time with the GST and all, as the tax revenues increase, good amount of money can be spent on the infrastructure, so whether it's roads, whether it's railways, whether it's power, ports, airports. So much of the urban transportation, you travel anywhere in India and you see some metro railway work is going on. I think some of these can become a growth driver. And if the rural economy does well because of the affordable housing, because of the government spending, if the private sector gets a little more confidence, another a year or two, if growth picks up and the global environment is conducive, I'm sure the private sector will also start investing, and the investment cycle will also pick up, because there are three major things which are required for the economic growth. You have the consumption, you have the investments, and you have the exports. Because of the global slowdown, exports were weak, but in last 4 months, exports have started moving up, and I'm personally very positive about the global economy. While the political headlines is very scary when you hear about the Trump and you hear about Brexit and you hear about several things, but underlying global economy is doing well, and which is reflecting in our exports picking up for last 4 months. Investment, as I said, private sector will take some time. government investment is picking up, but over maybe another year or two, that cylinder will start firing. The cylinder which is firing little today is the consumption, which I think particularly on the rural side can gather further steam. So that gives me hope that in next few years India's economy can do well, markets can do well, and I think if you invest systematically, if you invest in a with a discipline, taking a longer term view, and don't get swayed by the headline news, because markets will always have something. I know a lot of investors when I meet last few months, बजट के बाद देखेंगे, बजट में कल को लॉन्ग टर्म कैपिटल गेंस पे टैक्स लग गया तो या क्या होएगा, अभी बजट निकल गया, यू विल स्टार्ट वाचिंग यूपी इलेक्शंस, यूपी इलेक्शन के बाद में कुछ और हो जाएगा, एंड डोनाल्ड ट्रंप विल कीप यू बिजी थ्रू आउट द ईयर, समथिंग और द अदर headline will keep coming. There will be some election in France, some news from China, sometimes something will happen from an RBI policy. So something or the other will always happen, and that has always happened. But you only need to know one thing, that in 1979 when Sensex started, it was 100. So Sensex itself has gone up 270 times in the last 35 years. In next 35 years, I am not saying that it will go up 270 times, but let's say even if we replicate, yeah. So I am saying even if it can replicate a little bit, it will still be a very good return for most of the investors. And then, as I mentioned earlier, there are very few other avenues to put money. Look at the real estate, or you look at the gold, and the yields are falling. The deposit rates have come down so much, so the equity automatically is looking more attractive. There will always be some challenges. I am not saying the market will go up from tomorrow onwards. If you want to know that view, then there is a workshop going on in another room, but I wish if it was so easy to make money where one could predict where the markets would be next 1 week or 1 month, but that's not the trick. For any reason, let's say next few weeks, if you see a little bit of correction and then start investing, but I think the best way is to do through a systematic investment planning, look for some good funds and then start investing, and then try to participate in this great India story. So on that happy note, thank you so much, and if we have time, I can take some questions. Yes, sir. So again, I mean, it depends on how much time, resources, energy that you have, and your ability to analyze those companies and invest. Obviously, the companies that are small and mid cap, they carry higher risk compared to, let's say, the larger companies. So if you think that you are smart in terms of analyzing the business model, analyzing the management, analyzing the financials, you can assess the valuation and everything, and you can invest, it's good. Otherwise, the other route to do is, if you have the high risk appetite, you can invest in a fund which invests in the mid and small caps. That's reasonably, I would say, I mean, you're giving money to a professional fund manager, and he should do a reasonably better job than most of the other investors. And then also importantly, that I think it's the first thing is more important is getting the asset allocation right, that equity allocation, and within that, once you have put your allocation to, let's say, the large cap or the multi cap fund, and then if you have high risk appetite, some money can go into the mid and small caps.
You have got two funds. One is you have got one is your mid cap fund, mid and small cap fund, and another is only mid cap fund. So what is the distinction?
There's a small cap fund. The minimum 50% has to be in small cap stocks.
Okay.
The other is a mid cap fund. It can invest in all kinds of mid and small cap fund. But there we have a restriction of minimum 50% is small caps. That fund is closed for subscription now.
Which one?
The small cap fund.
Small cap. And you have got one SBI Emerging Businesses Fund. So what is the distinction for that?
So Emerging Business Fund is a concentrated fund where we invest in around 25 odd stocks, high conviction ideas with an absolute return orientation, but absolute in a long only context, that of course if market overall goes down, stocks can go down, but we try to look for companies that can deliver decent returns over a longer period of time, have a concentrated portfolio without looking at what is the market cap or in which sector they are. So it's benchmark agnostic, it's segment agnostic, and try to buy 25 companies across market cap which can deliver decent absolute returns over a longer period of time.
When you do asset allocation, see, most of us went totally wrong, and we were not aware of the rally which took place from 7,900 straight away to 8,700, and most of us were advised that we should put only into debt category fund because 2017 will be very volatile, and now everybody is talking about only equity.
So
Yeah, so now, when we do asset allocation, right now, what should be our strategy? Let's say that if we have
so अगर
100 rupees to invest.
2016 के बिगनिंग में मैं आपको बोलता कि Donald Trump will become the president of the US, Brexit will happen, Chinese currency will depreciate from 6.4 to a dollar to 6.95. There would be terrorist attack in Germany and some of the other parts of the Europe, so on and so forth. Would have said that I'll short US equities and I'll buy bond. The fact is, US equities on 31st December was at a lifetime, close to lifetime high. So sometimes I think that's what I mentioned, that I think we get too swayed by these headline and the news and what's happening around us. The trick to make money, to create wealth over a longer period, is to have that discipline. You decide based on your risk appetite, your time horizon, your liquidity preference and all that. Create a plan. This much of assets need to go into the equity, this much into the bonds and this much into the liquid assets. Within that equity, put in some good funds and then stay with that for a long period of time.
हेलो हेलो
और हमेशा रहेगा, ऐसा कभी होगा ही नहीं कि वर्ल्ड में देर इज नो रिस्क एंड एवरीथिंग इज नाउ हंकी डोरी. आई मीन आई कैन टॉक अबाउट 10 other, I told you about all the good that's likely to happen in India, but globally, I mean, you don't know if the way Donald Trump has been in last 20 days, you don't know if other countries start retaliating in the same manner, that we will not allow Americans to come, or China puts a tax on McDonald's and KFC and Apple phones, and then some other countries will do the same. It could be quite scary going forward. So every year there's always a lot of risk. 7 billion people will never live absolutely peacefully, and everything won't be.
Demonetization will be having a very significant impact in the formal economy. But now we hear it that informal economy has led to a lot of unemployment, and that effect is going to come after a couple of quarters. So what is
So
your
you know that, I mean, when I was talking about that there are so many things that as a nation we should take pride in, what kind of institutions we have created. Like say, 1 billion people have a biometric card. I mean, we are like one of the poorest country, and so many people are illiterate. It's not an easy country to govern, but 1 billion people have got a biometric card. I think we should thank ourselves, and we should be proud of ourselves that 86% of the currency in circulation was taken away in a country where less than 5% people have credit and debit cards. But it happened so peacefully and so smoothly in such a short period of time, and now you don't see any queue outside any ATM or any of the bank branch. I think that just shows the resilience of the economy. But more importantly, on the impact on the economy, our view was that there are 3 major impacts. One is a liquidity effect, which is that because there was no currency to transact, transactions were not happening. So a lot of slowdown just happened because you had a 2000 rupee note. I had, let's say, apples of 200 rupee. If you had to buy 1 kilo of apple, I had to give you a 500 rupee note and 300 rupee note, and I did not have those 6 notes, and that's why the transaction did not happen. Now that I have those notes, you have those notes, transactions have started happening. So large part of the economy has come back on track. Second is the wealth effect, where some people who have the money, they were spending on few things, whether they were buying car, whether they were spending on a high-end marriage, they were buying the high-end lehenga of 50,000 rupees, or spending in restaurant by paying cash. Today they'll be scared, and I think going forward they'll be scared, and I think so that's a wealth effect which is very permanent. So all the great fat Indian wedding, I think that will get impacted, no doubt about it, after the demonetization, because they could hear the finance minister saying these many people have bought the cars and these many people showed income above 5 lakhs. So these many people traveled in foreign countries. So the government knows, the government is tracking everybody. So that's a permanent effect. The third effect is the income effect. Well, let's say somebody has a power loom factory in Bhiwandi, or somebody has got a plywood or a marble shop in Ville Parle, Santa Cruz. They were buying in cash, they were selling in cash, they were not paying whatever duties, or they were not paying the income tax. Now they will have to decide whether they want to continue with that and close down, or they want to kind of re-engineer their business model. Earlier it was tough, because if I take this call that I'll pay all my taxes, nobody else is paying, his shop will continue, my shop will close down. But now it will change, because buyers will ask for check, and you will also kind of do that after the GST and all. It will become very tough to remain outside the net. This will take maybe few quarters, and I think after a few quarters things will come back to the normal.
Hello. Sir, can you just explain more on the hybrid funds and how it's going for a long-term purpose, and how can we club the SWP in that?
Yeah. So let's say if you have instead of doing asset allocation through a variety of different funds, you want to just put money in, let's say, one fund. So in our balance fund, we have roughly up to around 75% in equity, 25% in debt instruments and fixed income securities. Out of that 75%, at least 50% go in large cap, remaining up to 50% can go in mid and small cap. So it's a total bouquet of the equity instruments there. On the fixed income side of 25%, we'll buy government securities, we may have some corporate bonds, we can have some short-term securities, a mix of government bond, and both the portfolios are managed quite dynamically. So in one single fund, you've got like the equity instruments, large cap, mid cap, some small caps, you've got government securities, you've got the corporate bond in one single fund. So that's the balance fund. But there is a 75 up to 75% equity. So obviously there is a risk, because if the markets are volatile, the equity funds, I mean the volatility will be similar to, let's say, what an equity fund would be. It will be lower because 25% is fixed income. But if there is substantially lower risk appetite, then there are MIPs where there is, let's say, up to 15 or 20% in equity and 80% in debt securities. But then obviously your upside will be limited, downside will also be limited. So these are the kind of hybrid funds, and then you can structure different kinds of hybrid with different allocation to these asset classes. As you said about the SWP, the withdrawal plan. So yeah, you put money, and then instead of taking the dividend and pay tax, you can withdraw that amount as a capital. So it will be relatively more tax efficient.
So
Hassan.
I think the other speakers are waiting, and we are already late to schedule.
one more question, please. Hello, ma'am.
Thank you.
One more question, please.
I'm around. I think that there are the other speakers are already waiting. Okay.
Sir, I have a question. That is, digital technology is an asset. So, what will happen if there is an means if someone hacks this digital? It is globally interconnected. What precaution do we have
that's
in our
an
nation?
excellent point, because I think the more you are using digital, also that every time you are using your mobile phone, you are leaving a digital footprint. Whatever you are doing, you are using the Google map, they know where you are moving. Whatever you are on social media or anything that you are doing, you are leaving a digital footprint. So, and the uses of Aadhaar also over a longer period of time. So there are issues with the cyber security, with privacy and all. It's also a business opportunity for a lot of people, because there would be so much of investment that will happen there. I'm sure, I think we need a regulatory framework to deal with that. What is that people can access and what is that people cannot access? How do you deal with it, the cyber crimes and all that? So the administrative capability, the judicial capability, the regulatory framework, all these things need to be put in place. And at the same time, just like in India, we have seen for so many of things that if you didn't have as much faith in the police network, people have their own security guards in every mall and hotel and every place. Maybe for private sector, this will be a big opportunity to come with several kinds of tools and applications and things which can be used by businesses and individuals to deal with it. But that's a great point. As we become more digital, I think those risks will also increase. Thank you so much. God bless you.
I think those are very